Hey everybody, today we're going to talk about the stock market, investing, and trading. Let's first start with trading. Let me take you through my journey. I first heard about stocks in fifth grade when we had a little project. I came back to it in college and I started learning about penny stocks. I got online, started searching, and I learned about penny stocks first because it was a way to make money fast, according to, the article, and I didn't have much money. So how do you make a little bit of money into a lot of money? I was broke. I got full tuition to college because I was low income, so it was paid for. So I didn't really enjoy college, but I made use of the time there with learning about stocks and other stuff. Uh, 2016, bought my first penny stock on Robinhood, I believe. Well, actually, I think I had another broker. I don't even remember the name of that broker. It was like $6, $4 a transaction. So in 2017, I tried penny stocks with Thinkorswim, a platform that I will show you later on. And I was losing money, and I was following this guy on YouTube. Um, 2018, 2019, I decided that, hey, penny stocks is not working. How about I trade bigger companies like Apple, Tesla? But for that, I'm gonna need like $25,000. So I worked pretty hard, and I wasn't really trading. I was just working. Saved up about $50,000, and I paid off some of the loans I owed for summer school. And I lost, I think, about $3,000 during that period. And then in 2020, I was trading with the 25K account. I lost about $10,000 with really, really, really dumb trades. I traded penny stocks again here and there, but I was flipping back and forth between penny stocks and large caps, and I realized, I gotta stick to one of them. 2021, I tried a small account options challenge, so I'll talk about that more about options. And I didn't see much progress, and I wasn't really focused. Now 2022. I'm trading with the 8.5K account. Well, actually, was. Now I lost $2,000 and I'm still unprofitable. But, investing, I know a little bit about it, and I will share with you what I know and what I've learned, everything about stocks. Just kind of the surface so you get a gist of what's going on. So, the thing you'll need for investing, you just need a phone and like $200 extra a month. If you have that, you're pretty much set. For penny stocks trading, you need like a professional broker that's cost a monthly fee. You need like $25,000 to get unlimited trades, and the software is expensive because it's professional, it's direct, and Thinkorswim doesn't cut it. You need also like a $1,500 desktop with the 16 gigabyte RAM. So stock trading, same thing, about the same thing, just bigger companies. Options trading, you could do it with $1,000. I'm doing it with 8,000. I could cut it down to 1,000, but I kind of already trained myself to deal with large amounts of money and how to cut losses. So if you're willing to risk and lose $1,000, it could be a good form of education. Equipment wise, same thing. 16 gigabyte minimum RAM computer with decent graphics card. Costs you about $1,500 or more. So how does one invest in stocks? So let's slow it down. Let's talk about stocks. What the fuck? What the heck is a stock? Stock is just company. Hey, what kind of stock do you own? Oh, I own Apple, Amazon, Tesla, blah 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 blah. Which stocks are going down? And you say so and so. So stock is just basically the company. Shares is the pieces of the company. Straightforward. Each company has different amount of pieces. They're not all the same. When you buy stock, you're buying a piece, a limited amount of pieces. Each company has different amount. I think Apple has about 17 billion shares, pieces of a company. You just buy one, then you just own one 17th billionth of a company. Earnings is just how much the company's earned every 3 quarters. They announce it. They have a date. They either announce in the morning or in the night. So there's websites for that, and you will see them later on. Market cap is just shares outstanding per times current stock price. I forgot to put. I supposed to have a multiplication sign, not a plus sign. So please excuse that. Shares outstanding multiplied times current stock price. That gives you the market cap. So if Apple has 17 billion shares outstanding and the current price is $100, then it is the company's worth I think 170 billion. No, more than that, 1.7 trillion, around there, I believe. Yeah, 17 billion times 100 is a trillion 700, I believe. Um, Splits is just when the company has the stock price is so high and they just want to make it more affordable. Technically, it's not really affordable. It's just, sometimes stocks are like worth $3,000. Shares are worth $3,000, and like, okay, well, somebody doesn't have $3,000, but if we split it, somebody who has 300 could afford it. So you just can manage a piece of the pie. But technically, companies don't really have to split anymore because Robinhood and some other brokers have the ability to buy a fraction of a stock, so that's fractional shares, and which is pretty cool about Robinhood. Dividend and yield. This is important to know because you want to know how much the company is making. Sorry about that. You want to know how much the company is making, and it's basically how much it's earned in a year. And divide that by the share price and times 100. That gives you a percentage. So is it 2% per year, 3% per year? But you also got to take into account like the price of the stock. It's gonna go up and down, so the yield will always be changing because stock price always changes. Here are some brokers you might want to look at. So all these on the side like are a bunch of them, but the ones I use are Robinhood, Webull, and TD Ameritrade, but mostly TD Ameritrade for trading and Robinhood for investing. So how do you get started and buy? So let's look at Robinhood, or actually Thinkorswim. Thinkorswim, you download the software and you log in, and you get something like this, something messy like this, which is for day trading, which is ideal for me. I do options. We'll come back to this later, but something simpler is Robinhood. Type in the company, you touch it, you put trade, you put buy, and you select what kind of buy. So you want to buy in dollars, so this is fractional shares. So you want to buy $1 of one share of Apple, or $2 or $2 or the whole share. You just put buy in shares, and then, or you could make it so it automatically pays every once a day, once a week, once a month, once every 2 weeks, and you set the amount. Limit order is just like, oh, I don't want to buy it more than this price. Trailing stop order, so it says right there, if Apple rises above its lowest price by a specific amount, big trigger a buy order. So I think it's gonna be like a market order, and these are just other orders. They're not that much different from well, they kind of are, but it's not that important when you're investing. If Apple rises to a fixed stock price, so yeah, that's pretty cool. I mean, you can experiment with these. All right, choose frequency. Frequency is how often, where you want the money to get, where you want the money to be used from, your buying power, and then you select the amount. All right, where do I find earnings? They're here, Nasdaq. You look through them, you zoom in and out, you select the date, and right here, weekends are not included, so make sure, if it doesn't say anything, it's probably the weekend, but it tends to not show the weekend. Like, see, 4th to the 7th, it skips the 5th and the 6th because that was Saturday and Sunday. So right here you'll have the time. So this is a moon. So moon identifies that it's gonna be in the after the market closes. The Disney will announce. This is the market cap. See, Disney is 180 billion, and it will just be ranked from market cap, or you could rank it based on, I guess, symbol or something like that too. Tells you the date that it will be announced, and what's expected, and so on. Where to find earnings of stock I only care about. So I have TD Ameritrade, and TD Ameritrade is the same thing with TOS. So you log into TD Ameritrade, and you make an account with them, and you're able to make a watch list and filter out the watch list. So you click here, I put the combine of all the watch lists I have. So right here, some watch lists. You clicked on that and you add stocks you want to put that you want to watch. So for example, on the 9th, Rivian, Roblox, Fiverr, Beyond, Wish, and GoEV were announced already. Today we're in the 10, I guess. 10. That was for yesterday. What else we got? What kind of stocks are there? So there are so many types of stocks. So over 5,000 publicly traded companies, either on the NASDAQ or New York Stock Exchange, but they both come out on Robinhood and TD Ameritrade, all brokers. So you have sectors like transportation, cars, computers, chips, technology, healthcare, real estate, entertainment, retail, aviation, military, mining, oil, metals, commodities, construction, social media, advertising, internet, food, electronics, gaming, ETFs, mutual funds, REITs, indexes, etc. So you have so many options, but some overlap one another. Like for example, cars could be also technology, like Tesla and so on. ETFs is exchange traded funds. Mutual funds are like a company that trades for you and try to beat the market, and you pay a little bit of fee. REITs is real estate investment trust security, something like that. I think indexes are just like the S&P 500, a SPY, and it pretty much tracks the top 500 companies, and you get the average. That all right. What stocks do I like to look at and why? Boom. So here's a list of stocks, and they are ranked based on market cap. So the biggest companies are Apple. So if you multiply $138 times the shares, 15 billion, so it's 15 billion shares, you get market cap 2.2 trillion. So M million, but this is 2.2 million. That's a trillion. Okay. So these are all the companies. Here are the names, just so you can see: T-Mobile, McDonald's, blah 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 blah. You have more. Here's another one. Um, See, the market caps are decreasing steadily. You can take a look at them. These are like the ones I mostly focus on, or that I actually kind of pay attention out of the 5,000. And there's like here, I think there's like maybe 100 of them, or a little bit more, maybe. And that's it for those. Invest in stocks that are financially smart, just like a life partner. That's something to consider. If you're looking at a company, you know, you're investing in that company for life. Hopefully, if you're investing, if you're looking for a partner, you're also gonna do the same thing. You're gonna make sure that they're financially stable and they're able to keep a job. What controls the overall stock market? So here are some things that control the overall stock market. We're going to talk about the Fed funds rate. So what does it do? The Fed funds rate. The Fed funds rate makes it costlier to take out a loan, causing people to borrow and spend less, effectively pumping the brakes on the economy and slowing down the pace of price indexes. So right now we're going through an interest hike because inflation is up. So here's the percent of the federal funds effective rate. So how much bank or borrowers are paying interest for loans. For example, right here we have like I think currently was showing maybe like 3.8 or something like that. And when you want to buy a house, the interest on that house, the loan is gonna cost more because it's higher. When it was low, like right here, it went down all the way to like 2.5 interest for a 30-year loan. Now it's up to like 6 or 7, I think. So it does affect, the borrowing possibility. So this is from 1975 or more to all the way to 2022. And you can see here, because interest go up, the economy, stocks go down because borrowing decreases. Borrowing encourages the economy to move. So when people borrow, they spend. When people spend, that becomes other people's income, and the economy seems to be fine. But apparently, we did too much of that, so they caused inflation. So here's a cycle. So in the past, from 2016 to 2020, there was interest going up, and during this time, stocks were volatile, but overall they were going up. People were not too scared, but then it reached a point where, like, hey man, like stocks are going, interests are too high, and companies are gonna struggle to borrow money, and it's gonna cost them. So people, you know, are concerned about that, and stocks peak out and had enough and start dropping. And but then they, like months later, they reach a bottom when they realize, hey, they're actually gonna slow down rates, and rates might start dropping. So stock bottom out and slow, because of slowing interest rates. So stocks technically go up during this period, but then stock drops again when the pandemic occurred. So boom, pandemic occurs. Interest rates were going to drop either way, but they dropped dramatically. But this this didn't really cause stocks to go up right away, but it kind of, they all dropped together because they're all scared. Everybody's scared together. But very sharply, stocks, boom, also rebounded as soon as the government said, we're printing money and bailing out people that are in trouble. Like, so much money was pumped into the economy, trillions of dollars. And during this time, 2020 to 2022, stocks just freaking blew up, not down. They went up like crazy. And then again, you started hearing about like, hey, inflation's occurring, and people were like, oh, inflation's occurring. What does that mean? That means the Fed is gonna raise interest rates. What does that mean? Well, what happened in the past when interest rates were increased, stocks started to go down. So now we have stocks that are going down, and now we're waiting to see that the inflation starts going down. So if inflation starts going down, it shows that interest rate hikes are working, and they might slow down, and eventually stocks will go up. So here's an example of basically overlapping. So one, so this is one overlap with this. The dates and everything is 2016 right here. You can see, and this is at point two when stocks were like, hey, we had enough. When stocks said we had enough, and here's three when they pretty much bottom out, like they started realizing like, hey, the Fed is gonna lower interest rates, and then because they realized that, okay, the Fed is gonna ease off interest rates, stocks went up, all this, and then the pandemic occurred. Boom, everything dropped, and we have four where everything dropped, and then five where everything bottom and interests were on the bottom. So we have so many great things happening. We have one, interest rates are low. Two, the government is printing money, and three, people have a lot of money to spend. So, and they're pumping into stocks. So we see this movement from five, and then from five we go to like, I think SPY went up to like, man, I don't know. Let me see. I had to Google it, not Google it, but look at my. Oh shoot, I left my watch in my friend's car. So if we look at the SPY. Let's see, SPY. Sorry, guys. I mean, I could pull it up but SPY went all the way the high of 474. So more than $100 from this point. The SPY went up. That's crazy. And here we have the inflation index, median consumer price index. Inflation was the same thing. So it's been going up, and now it looks like it's coming down. As soon as we see inflation going down, that means that the federal government, or the Federal Reserve, could start lowering interest rates and attract um, people's anticipation that, hey, it's time to buy stocks, or we're able to buy, get loans at a cheaper rate. So everything gets priced in pretty fast. Another thing to consider is we have the yield curve. Whenever it's curved in a positive direction, things are good. Stock markets are rising. So you can see here, it dropped, and once it dropped, the interest went in a positive slope, and then they rised. Right here too, they bottom out, and then for everything else was like, the slope was pretty positive. Right here they became negative, and then that's why I have that too, reflecting this too right here. All right, so, and then this is an inverted yield curve where it's negative curving, and that's at the peak when people had enough. Like, hey, man, like interest rates are high, so what the heck? Things are looking not so good, and that's where we're at right now. We're like, things are not so good. And that's why stocks are dropping. You can see here. What else controls the market? Unemployment. So you can see here, when unemployment was going up, boom, recession. Employment was going up, boom, recession. Employment was recession. And then in 2020, big ass recession. Not recession, but like big unemployment rates, thousands of persons. So 24,000, so 24 million. Is there a way to make income out of stocks besides dividends? Yes. My investment strategy. Wait. Besides dividends, I think I meant besides investing. Have some cash. So my investment strategy, if I were to invest, this is not really accurate. Like, yeah, If I was investing, yeah, I'll put like $200 a month in stocks, have some cash on the side, like 2K just in case if there's a big dip, big buying opportunity, buy 50 on the huge dumps for each stock and stuff like that. Do this for life and never sell as long as the company is strong and has a future, basically. So that was done. That's it for investing. Like if you follow this chart right here, this and kind of anticipate, like basically when this is going up, at some point you want to slow down your stock purchasing. Slow it down, not stop it. Just slow it down. Right here, you slow it down at this phase, and then at some point you want to be very aggressive, like right here, and then you right here you buy consistently, and then right here you just also buy consistently but smaller size, and then right here also consistent. So this whole entire area right here, consistent buying, slowing down of buying. So you slow down your buying on this area. Okay, slow down buying, aggressive buying, or consistent buying. That's basically it. Because they all move pretty much move together. If you look at SPY, the Apple chart looks pretty much the same. Tesla and so on, Boeing. Boeing a little bit different because some controversies and airplanes crashing and stuff like that. But for the most part, they all tend to look about the same. This one's also an important chart. So active stock trading. Now we're talking about stock trading. So we're talking scalping trading, day trading, swing trading. Scalp trading is seconds to minutes. So you hold it for a second, 2 seconds to a couple minutes. Day trading, a couple minutes to hours. Swing trading, overnight to months out. This is like making bets on something is gonna happen, but it's better because you don't have to lose all the money you bet. So in the casino, if you bet money on a horse, if you're wrong, you lose all the money. In stock trading, if you're wrong, you can get out before it gets even worse. The only thing is the return range widely and it takes many tries. Making money off stocks is like scalping event tickets. So you could be wrong. So you buy an event ticket hoping to resell it. Maybe a lot of people don't have a craving to go to that event, and it's not selling. So you gotta cut your losses. You gotta sell it for less than what you bought it for. So you lost some money, but you didn't lose all your money, right? And the way you make money is, hey, you anticipate that it's gonna be a big event, and hopefully it does, and people end up buying your ticket last minute. You can make money when the stock goes up, aka going long, being bullish, and when the stock goes down, aka going short. That means being bearish. Buying is very easy. Just press the buy button and straightforward. Shorting, not so easy. I mean, you could just press the sell button and see if it works, but a lot of times it doesn't work, and you need enough money to cover the stocks you're short. And not all stocks are tradable. Brokers don't have all the stocks for you to borrow. You can lose more money than buying stocks when you short. And when you sell, you borrow shares from a broker and sell them if you think the stock will drop in price. And if it does, you buy it back, and it automatically goes back to the broker, and you get to keep the difference. That's what's happening. If it doesn't go any lower, you have to buy back at the more expensive price and swallow the loss. It's cheaper to buy a put. More on that later. So there's an alternative way to shorting stock, which is options. Isn't the market unpredictable? Well, yeah. This video, I guess, I don't know if I go to it. What happens if I go to it? Oh, it shows you how much stock market can move. So you can see here, stock market moving up and down. This is Tesla, I believe. Up and down, up and down. So it's pretty volatile. Just to give you an example. See this price moving. This is fast forward also, so that's why it's moving crazy. Let me see. Go back to my slide. All right. So the reason they're called bullish is because bulls, when they hit something, they go up. And bears, when they hit something, they use their paws to go down, I guess. So these are like patterns. You'll see patterns that for going up and patterns for going down. And here's bearish patterns going down and bullish patterns going up, and they're pretty much the opposite. You can see they're pretty much like a mirror of them each other. If you put like a mirror, then you'll see the opposite. And the names don't really matter. You just gotta, get familiar with what tends to happen when the stock's moving in that type of form. Um, Here you have reversal patterns. And just because the pattern's showing up doesn't mean it's gonna happen. It's just more likely to happen. And if it doesn't work, get the hell out. Here's a pattern of just a trend. A trend. They don't even have a trend here. Oh yeah, here's a trend. Rising value, I guess. So this is a trend. And there's a trend right here. So up, down, touches, up, down, touches. And this could be an entry point where you want to get in. So touch twice, 3 times. So 3 times is pretty good confirmation. So this is a trend pattern. Right here, what am I trying to show you? What am I trying to show you with this? Well, for trading, I guess if you want to trade, this is the platform you use. Thinkorswim, it's free. Here you have buy buttons, sell buttons, but I have hotkeys, which is like you go to settings. So here's this hotkeys. So basically, I put a command or tab, 0 and minus for buying the bid, selling the ask, or option O for buying the ask, and option P for selling the bid. And the bid, as you can see right here, like this is the bid, this is the ask, right here's bid, ask. So the ask usually always is higher than the bid. So if you want to buy right away, you buy the ask and you pay 3 cents extra. So you can see here, you pay 3 cents extra to get it faster. But if you want it to come down to your bid, then you just wait a little bit longer. Sometimes you get lucky if the company is very liquid. So here we have a daily chart. You could adjust these things so much, like you can make it your own. This is for options or stock, but right here I have option codes. These are option codes. You have Tesla option puts on here, and you have option Tesla calls on this side, and you also have a SPY. You go to trade, you'll see later on. So this is a downtrend. You can see, I guess, I don't know where I was trying to go with this. The pre-market broke the trend and then it came down. Oh, actually, I think this was a reversal candle. So this candle gets engulfed by this down candle. So in this case, purple means down, yellow means up. Instead of green up, red down, because I'm kind of colorblind. So these colors I recognize pretty well. And so yeah, there's engulfing candle. So engulfing candle means that, hey, the up movement is a fail. So let's try the down movement, and boom, the down movement does work. It goes down 1, 2, 3, 4, 5, like $5 or more. Is there something more risk and more reward? Well, you have option contracts. Now let's talk about option contracts. So you go to the trade tab and you go all products, and now you have options. So the way options work, you type in the company and you get all the options for. Right here I only have 20 sections. So on this side we have the calls, as you can see here, calls. And on this side we have puts. If you think the stock's gonna go up, you buy calls. If you think it's gonna go down, you buy puts and buy. Okay, and you have too many to choose from. You wanna buy in the money or out the money. So in the money just means that it already reached the level you wanted to reach. So the current price of Apple is 138. So anything below 138 is in the money for the calls, right? Anything above that is out the money, meaning it has no real value. It's all extrinsic, meaning it's all made up. It's all hoping that it goes up. And then right here on the opposite side, for puts, anything above 138 is in the money. Everything below is out the money. Because hey, for puts, you want the price to be below where you think is gonna be good. So for example, 135, I want the stock to drop to 135. So it's not there yet. The price has not reached that point. So it hasn't dropped below that. So it's not in the money. But anything below these strike prices, it's in the money. And the opposite is, hey, I want Tesla to go to 145, but it's not, hasn't reached that for the calls, so it's out the money. It's not worth as much. And then you have all these other dates that are far away. These are how many days there are out of reach. So 800 days, January 17, 2025. So that's almost 2-3 years from now. But they are very expensive. The further away you go from the current date, is the more expensive they will be. And also, the more in the money, the more expensive they will be, because that's how much value they have. So it's the value is 138 minus 129. That's about $9. So $9 like $900, but right here it's adding $300. So 900 plus 300 is 1200. All these numbers you have to multiply times 100, because they all represent 100 shares of stock in all cases. So 100 shares of stock. So this is actually $1,205, and it has $3 of extrinsic value. The intrinsic value is only $900. So let's say it does reach, it stays above 129 until expiration, which is 12 days from this point, and it only stays around 129, then you could lose like $300, because it's only stayed there. So yeah, just because you hold it and you're still correct, so you could still lose money. Hopefully it goes, instead of 129, it stays around 133, and that's pretty much your break even. 133. See, because that one's almost 900. Anyways, let's go. How do they work? So when you buy one call, you get the option to buy 100 shares of a stock at the strike price if it is reached, aka in the money, has intrinsic value, or you can sell the contract now that it is worth more. All right, when you buy one, you get the option to buy 100 shares of the stock at the strike price. What is a strike price? These are strike prices. Okay, these are strike prices. You choose which strike price you want. It just depends on your strategy. Hey, I think Apple's gonna go above 140. You're saying above, so you buy a call. Hey, no, I think Apple's gonna go below 135. Below, so you're talking about puts. You're gonna buy a put. So right here in this case, we're talking about call. You have the option to buy 100 shares if the strike price, if it is reached, aka in the money, has intrinsic value. Okay, you can still lose money because of the extrinsic value. You tend to make money, you will make money if you still have time. The more time you have, the more extrinsic value you have, right? Extrinsic value depreciates, intrinsic value does not. All these out the money contracts have pure extrinsic value. Like, why should it be worth 395 when it's not even there? Well, you have 12 days for that to happen. You have 12 days left for the stock to go above 139, which it could happen. Right here it says that it has a possibility of moving up or down $8. Okay, so this affects how these get priced. All right, and for puts, when you buy a put, you get the option to sell 100 shares of the stock at your strike price if the strike price is reached, aka in the money, or aka has intrinsic value. Or instead of selling the 100 shares, you can sell the contract now that it is worth more. So the contracts appreciate, they depreciate, as seen by this right here. See, this contract is appreciating or depreciating. You can sell it at any point. This is 9 a.m., 10 a.m., 11 a.m., 12 p.m. So Tesla stock, Tesla options, Tesla stock, Tesla options. This is the SPY, S&P 500. See how the stocks kind of move together. SPY moves down, up, down. Tesla moves down, up, down. Same thing with options. So for a call moves like a stock, down, up, down. Puts move the opposite. They move up, down. So because it moved down, it went up. And instead of going down, when this went up, it stayed sideways. Because we're talking about 210, and 210 is right here. This is 210. That's 9. Okay, so that's why. Because at 9, it already was at the point where 210 is. So this is about to reach intrinsic value. So it's $100, but then it reaches way below 10. So it's in the money $6 at some point. In the money $6, so that reaches up to like $700. And then it goes back up to close to 10. And the difference is like almost $3. So that's why it closes near $3. Pure intrinsic value at this point. The call option was nowhere near. So 215 right here. It had value in the beginning, but then once it dipped below that, it lost value, never reached back. Eventually, it's only worth $1. Basically zero. You lose that dollar. So that's how options work. And this was only in a day. So if you were to buy this one, which was like, I don't know, maybe like, this was maybe as cheap as $30. It went all the way to $695. $30 into $600. That's crazy from one contract. Insane. Obviously, it's difficult to catch those movements. All right. If your call or put do not reach their strike price by the time of expiration, they are worthless, meaning they don't have no value. Just like I showed you. This one, they both expire, but this one expired with value because it was in the money. This one expired with no value because it didn't reach its goal by expiration. They all expired this day. Where are we at? 11/4. That was a Friday. They all expired on a Friday. Please note of that. Where is it? So these dates are all Fridays. The 11th November, 18th November, 25th of November. They're all Fridays. Okay. Maybe there will be some exceptions where the market is closed on a Friday. Which is the right option? Depends on how much time you need and how far from the money. This all depends on your strategy. If you're scalping, you're probably scalping contracts that expire the same day, like on Friday, or a weekly, or daily. A daily refers to a stock that expires the same week. A weekly is like maybe a contract expires next week or more. Leap options, they expire months from now to years from now. That's because, hey, I don't know when the stock's going up, but it's going up and I just want some time. And you buy it far away from the money just so that, it's cheaper. But, it's like GameStop. GameStop was, if you bought one so far away from the money and with a lot of time, you would have made a lot of money. It would have been cheap too because it's so far away from the money that nobody expects that to happen, and when it does, it's like, oh shit, it's a shock. It's a big shock. So at the money options, where the current price is at, which is basically at the money This is at the money. At the money is 138, so 138 or 139 for puts. In the money, your strike price is hit by a good amount. Out the money, your strike price has not been reached. 0 days to expiration, 0 DTE, that's an abbreviation. You have 6 hours or less to trade. That's on a Friday or Thursday when Fridays are closed. Can you short options? Yes, you can. So, not recommended. It requires enough money to cover 100 shares for each contract short. It's almost like shorting stock. So, it's the same. It's kind of silly why you would want to short options. But, some people do it because options depreciate. And because they depreciate, they kind of make you gain a little bit more than just shorting stock. And so when you sell it, so let's just read this. Sell a call because you think the strike price won't be hit, so you keep the premium. So if you sell it for $300, so let's go back to, so right here you can sell any of these, but you gotta have enough money to buy 100 of Apple shares. Same thing for puts. You have to have enough shares to sell them or buy them or so and so. So if you're gonna short something, it's because you think it's not gonna re-reach. For example, 140. Hey, I don't think it's gonna be reached. The Apple's gonna go to 140 by 18th or by tomorrow or 2 days from now. So you sell it. You collect $350, but doesn't mean you keep those $350. It has to go to $0 for the contract has to expire worthless for you to keep all that money. Tomorrow it could be worth $2, so you only keep $150, right? Make sense? You only keep however much the difference is from the current price. Um, so that's the thing. But what if 350 doesn't gets reached, and now instead of 350, now it's worth $700 because Apple went up all the way to like 145. So now you gotta buy it back for more. So now you lost money. So that's why and that could go up by a lot. Stocks could go up infinitely. Obviously, they don't really do, but they could go up by a lot theoretically, and your losses are unlimited. So you gotta be careful. Um, so sell a call because you think the strike price won't be hit. So you keep the premium you sold it at. But if you are wrong, you either buy back the contract at a more expensive price or execute the call, which is done automatically by the broker. Um, execute the call option contract agreement, which the agreement says you sell 100 shares of stock at the strike price to the owner of the call contract. That basically means because you were wrong and you sold it, now you have to agree to sell 100 shares of that stock at the strike price. And that sucks because the strike price, for example, if somebody buys, you're the seller of one, let's say 140, you sold this one. But now the price of Apple is supposedly 145. So this is going to be worth either like $700, which you buy back and you lose almost $400, or you have to um, sell 100 shares at 140 and then miss out on the move to 147 or 145, sorry. So if you don't have the shares but you have the money, you technically end up selling at 140 and you have to buy them like at 147 or 145. So you have to swallow that loss. I hope I'm not losing you all. I'm kind of losing myself. Let's look at a put. Let's see if that helps. So when you sell a put because you think the strike price won't be hit. So you keep the premium. Same thing. All we're changing is buying or selling, put or call. But if you're wrong, you either buy back the contract at a more expensive, same situation, or execute the put option contract agreement. Now you have to buy 100 shares of stock at the strike price to the owner of a put contract, right? So for calls, you have to sell 100 shares of stock at the strike price. So let's say you own 100 shares. So let's talk about the call again. The call. Let's say you sell the 140 call. Somebody, if you sell it, that means somebody bought it, right? You sell it, the stock goes higher and it reaches 145. And it's Friday expiration. And the contract gets executed because it's in the money. That means you have to sell your stock for 140. You have to sell your stock for 140 instead of selling it for 145. So you miss out on $500. Well, you actually lose $500 because you sold your stock for less than what it is worth now. Or you can sell the contract, buy back the contract and for more, which you lose money. So same situation, okay? And for puts, a put, somebody that buys a put is hoping that the stock goes below. So for example, let's look at puts. Let's say you sell a 135 put because you don't think that Apple's gonna go below 135. You think it's gonna go higher. But you're wrong. You don't get to collect the 264 because you held it till Friday. And now the person that actually bought your contract wants to execute the contract. And now you have to buy the stock at 135 from this guy. Let's say the stock ended up dropping to like 130. Well, you now have to buy the stock at 135. He gets to sell it to you at 135. But he gets to buy it back at 130. Or actually, either way, not buy it back, but he sells it to you at 135. So he saves himself $500 headache. You have to swallow that headache because you agree, hey, if I sell this, I agree that I will buy it for 135 if it goes lower. And it did. So now you have to buy it for 135 when it's actually 130. If you want your shares back, now you have to buy it for less. You have to so you sell it for more. Sorry, you buy it for a lot and you sell it for less. Another part that's kind of confusing, but that makes sense. You sell it for you buy it for a lot and then you sell it for less if you want your money back. But you lose $500 basically. You kind of get to keep. When it expires, you kind of keep the premium. But the premium is technically, by expiration, the premium is gonna be $500. $500. You sold it for 167, so $500 minus 267. You ended up losing technically $300 around there, or 250, or to be specific, 246. I think. Not good with math. 240, 236. And that's what happens, you sell a contract, You lose 236 if you execute the contract. You lose same thing. You lose 500, but you collect 264. So yeah, you lose 236, $236. Basically being the same thing. All right, all right, all right. Hopefully that makes sense. When trading options and stocks, you want liquidity, easy access to stock with a small slippage. So you want it to be able to go in and out fast with no ease. Instead of waiting a couple seconds, like I'm not getting filled, the spread's too wide. Liquidity means the stock's moving up and down fast and very fluid. Two, volume, lots of people are participating, lots of shares are being traded. Lots of volume is something more than a million, more than 2 million. Small spread, so right here it said bid as the spread is 2 cents. So from 16 to 14, 2 cents. Attention, a lot of people are talking about trading it. 5, intraday pattern you are comfortable to enter a trade. Room to move, daily pattern, just a bigger scale of intraday pattern. So you see a gap, tracement, breakout, etc. 7, mental toughness. You have to pay the price and be confident in knowing why you are putting on a trade. And why is because the intraday pattern makes sense and the daily pattern makes sense. 8, a target. You need to know when the heck to get out, when to take profit. You also need to know when the heck to get out, when to cut your losses. And that should be done faster than when you take profit. Here are some websites you can use. You can use Finnbase. You can type in stocks, and it will show you more details when you type it in. For example, Apple, you have all these stats, the volume. Like you see, the volume right here is 81 million. God damn. This is a daily chart. You can change it. This is 2 year, 1 year, year to day, and 6 months, 3 months on 1 day. Here are some more details. You scroll down, gross profit and so on, gross revenue, blah 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 blah, revenues, US dollar, cost of revenue, and so on. Finviz is also cool because you could type in the stock and it'll show you a daily. So right here we're talking about room to move daily pattern. That's what Finviz kind of shows you. So Tesla, the room to move is from this line right here, which is like 200 all the way down to like 180. I think if you're to like zoom out more. We also have Google Finance, almost like Yahoo Finance. Use Yahoo Finance, almost same thing. You click stats and you show you kind of like how Finnbase shows you this, but maybe a little bit more in detail. You also have Trading View, just you can move around the graph and it's pretty interactive. And I think you could do indicators and so on, lines and mapping. But TD Ameritrade, Thinkorswim works just fine. Here's another thing, schedule of release of employment situation, just so you can stay on top of what's the employment situation. Here are some other bunch of links, and so many of them. I think these are YouTube channels. Some are crappy, some are not that good. I could press some of them. Let me see what happens. Financial argument. This one's more like a catastrophic type of, like doomsday type of channel. I don't recommend it. And here are more YouTube channels and websites and so on. And there's also like websites where you can check, what's it called? Information on that's important. For example, routine, dynamic yield curve. I don't know where I put it. Basically, where it shows the schedule. FOMC meetings, I guess. FOMC meetings. Yeah, here we go. I guess when they meet, that way you can have an idea of when to pay attention to what's going on in the stock market, stuff like that. Let me bookmark this. Economic data calendar. Also, it's also cool. Like for example, today, Monday, November. So today, CPI core CPI was released at 8:30 a.m. and it did have an effect on the market. So that was kind of cool, and it shows you the results. Initial jobs and claims, actual forecast, actual forecast. So it came up higher than the forecast. So all this cool stuff. So it's kind of cool. All right. So federal budget compared to a year ago. New York Fed President John speaks. So that should be important too at 6:35 p.m. And I think this is Eastern Standard Time. So that's important to keep in mind. So we'll put that to our watch routine. So that's pretty much all I have. And you make your judgments based on whatever these people say, these presidents say. All right. See y'all later. Well, there's also a YouTube channel. Maybe you can check out Stock Market Live or Stock Market Trading Fraternity on YouTube. Kind of cool channel. Pretty informative stuff. Let's see, Stock Market Live. Stock Market Live. Stock Market Live. This guy.
His 10
He's live right
is
now.
that the government picks the lottery winners. And he was like, that's it. He was like, how come we never seen them? We never see them. It's all
He also has
anonymous,
a.
and then that's it. I think they had
He also has a watch list. It's kind of interesting.
had a wonderful day. On every watch
Goes
list.
over
I
some
am
stuff. You can like fast forward. We'll play out. Blah 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 blah. He's cool. He breaks it down pretty cool and entertaining as well. So those are two channels. So that's all I got. Hope you guys enjoy this 1 hour video. Let's see how do I close this. What the heck's going on? All right, there we go. Bye bye, guys. Subscribe. Maybe stay to the last minute.